looking at a UWM rate sheet, okay? And I'm going to take you through why they're doing what's doing. So I have to give you the stated purpose of doing what they're doing to change the loan level price adjustments is they're meeting the request of the federal government to try to make it easier for home ownership, okay? So in essence, what they've done is they are making it easier for a homeowner with high loan to value, low down payment to get into a house. Okay, that's their stated purpose, and that's what they've done. So they have changed the loan level price adjustments. The problem with this is, and it's really funny. Can you see the top line? Can you see
Yep.
all that?
Mhm.
Okay, so here's the whammy. The reason that they've done that is because the private mortgage insurance, the PMI mortgage companies, have raised rates. Okay, now why have they raised rates? Because they see clouds on the horizon. So on average, the PMI rates have increased by about 17 to 25%, depending on the down payment. So Fannie and Freddie are saying, look, what risk do we really have if we've got a mortgage that's insured by an independent mortgage company? So yes, we are going, because our liability is limited. We only have to suffer losses if the property loses money below 80%. And since at this particular point, there are a lot of properties at about break even, our exposure is very limited. And so for those people right now that want to go buy with 3 to 5% down, yeah, our margins are larger to try to accommodate loan losses in the future. And so we're more than willing to adjust our loan level price adjustments because we know PMI is going to back us up. We're not having to worry about losing any money on that first 20%. That's all we got to do. And he said, look, those of you who work in the government lending space, if you're talking about Ginnie Mae is in the same position. They cover the first 22%. It's 78%. So once the losses go below 78%, if the house is a $100,000 mortgage and your net is $78,000, the lender's not getting affected at all. However, Ginnie Mae is. If it goes below that, then the lender can be affected. They'll take part of the loss. We're in the same position, more than 80%. So, of course, it makes sense for us to look good. And politically, we have to look good right now because we're being told that we need to help home ownership. But since we don't set pricing and we don't set rates, we are trying to do our part to make home ownership easier. So here's a rate sheet, and I'm just going to go across the top here. So, and I'm doing the first one purposely, okay? So when you look at this, a par rate, okay, somebody who would not pay any other fees, the loan level price adjustment, okay? So a perfect borrower, according to Fannie and Freddie, and the borrower that they use to calculate what the average interest rate is the top line. 780 credit score, that's 75% loan to value or less. Now think about that. How many 780 credit score borrowers with 75% loan to value have you done recently, or maybe ever?
That's a unicorn.
That's right. Okay. Now, what's funny about this is, okay, so if you're at 760, you start paying points at 75%. You're going to be paying points. You don't get paid points at 70%. At 740, you're paying points to 60%. And I want to read the laugh at one. It's at the bottom one, 620 to 639. You're paying points at 60%, from 30 to 60%, not at 50 to 60%, from 30 to 60%, you're paying points. Okay, so when you look at this, you can take any of these, pick any credit score you want. You know, I'm going to use I'm going to use 720 to 739 at the moment. So from 60 to 70, you pay the same amount of money. From 70 to 75, you pay an extra half a point. From 75 to 85, wait a minute, you pay the same point. Well, that's where it gets weird. Why is that? Well, from 75 to 80, you're paying an extra half a point to go to that 80% loan to value thing. From 80 to 85, you got mortgage insurance, but you pay the same cost, fees. And then look at that, from 85 to 90 on the 720 thing, your cost goes down. And oh, wait, at 90, you have a lower cost. And at 95 to 97, you have a lower cost. So that's counterintuitive to what everybody thinks it's going to be. However, it's because PMI is there to backstop them. So they're not double dipping. They're not saying, well, we got PMI and we hit you with a bunch of money. They've now said, okay, well, we don't need to make as much money on these because here's the whammy. We're going to make it tougher for them to qualify. And so then the questions start popping up on the screen. What do you mean tougher to qualify? Well, DU now will not accept a 50% back-end debt ratio on anything greater than 95%. So if you're at 95% to 97% and you have a 48% debt ratio, DU is going to say no. Okay. Secondarily, the debt ratio from 90 to 95 is going to require at least 2 months reserves to get a 50% debt ratio. Okay, these are hard stopped into the computer. So whereas before they would have accepted those, now they're not. And they're looking at these facts going, reserves. These are all things that are important to understand for qualifying. So reserves, how many months reserves? And here's another change. Fannie and Freddie through 17 to 20 consider reserves to be how many months worth of mortgage payments do you have in the bank. Now they consider reserves how many months of all debt do you have in the bank. Okay. Yeah. So, but we don't see that, but that's what they're doing. And they're doing it because they realize that we are hitting a choppy period. They expect wages to stagnate. Literally, that's what he said. We expect wages to stagnate by the third quarter this year and probably go down. We expect unemployment to hit 5.5% to 6% by the first quarter of next year, and wages to stagnate by the fourth quarter of this year, which is going to cause a ripple effect throughout the industry of home prices declining. We understand that. Fannie Mae has priced in the fact that we think there's another 10 to 15% in property value declination coming in the next 18 to 24 months, with the majority happening in the next 12. So when you look at this, if you take 18 months from now is the end of 2024, 24 months is the middle of 2025, which, coincides with kind of where I think we're going to be, but that's the way they're looking at it. So when you asked about what they're doing for loan level price adjustments, that's why. PMI is covering their butt. PMI is more expensive. Great, we'll make it easier to get the loan for the cost-wise on our part, so it's not a double whammy, but they still got to qualify.
And making it more
Right.
more stringent qualifications.
Correct. Okay, and so when they go to one other thing to think about here and know in the back of your brain, I know you and I have talked about it, we've trained on it. Single premium mortgage insurance will not be available from 95 to 97. Neither will be lender paid mortgage insurance. Lender paid mortgage insurance is like when you look at a rate sheet and maybe the people have 900 credit scores and maybe at the 95%, that might be 3 points. Well, you might be able to get a rate with a super high credit score that could pay that. They're not going to allow lender paid mortgage insurance from 95 to 97, no matter what. It's borrower paid, period. Secondarily, the single premium mortgage insurance. The other one is split premium mortgage insurance will not be available for 95 to 97, but it will be for the 90 to 95. So this is all good. So you understand, why pricing is the way that it is, one of the other things that they commented on is, okay, so um, one of the changes they've made. So if a borrower decided that they wanted to take a cash out refinance with the sole purpose of paying off a student loan, they're going to count it as a rate and term refinance. This is a change. This is a very large change.
That's
Okay.
a better pricing. That's better pricing.
Right. But it's a very large change.
Huh. Well, why are they? That's curious because now we've got the student loan forgiveness stuff back in the headlines. Why are they doing that if there's still the possibility of a lot of those loans being wiped out? What's the logic behind that?
Well, the logic behind that here right now is to try to get these people to be able to get the normal flow of homeownership going. The normal flow is first time buyer owns the house 5 to 7 years. First time seller sells it, buys a second home. Second home they own 7 to 10 years. Third home is 10 to 12 years. Next home is the 15-year home. So to get people into that normal thing, the number one problem to the people that are first time sellers aren't selling because they have a bunch of student debt, and because they have a bunch of student debt and they have a bunch of equity, they can't sell and qualify for the next one. So what they're doing is they're saying, great, well, if we do a refinance right now and we put them in a better financial position, because again, student loans right now, this came about when the government stopped doing 0% on the student loans. They went back up to 10%. So student loans are roughly 10%. Well, we can loan them a rate and term refi at 6.5%. It works to their advantage, and it makes it so that they are a better risk to us, because then they have more discretionary to spend other things and they are more liquid. So, and it's not a huge debt. So that's what they've chosen to do. Cash out refinances, okay, number one, the 85% cash out refinance that was around is completely gone. It's 80 only. And when you look at the cost to doing these things, I mean, look, if you had a 680 to 699 credit score and you're 75% loan to value, the cost starts at 3.75 before you hit any of the other whammies. So, cash out refinances are a good idea, but we just, we got to make people understand that it's not market rate. It's a different rate. Okay. So then these other price adjustments, okay, these are the Fannie Mae normal adjustments. Just, one of the things that they've decided that is in homeownership is that they really need to encourage homeownership, and the lower end of the homeownership world is manufactured housing. So that in Freddie Mac, it's a point. With some of the some lenders charge a point or two. They've lowered their overlay to a half. Okay, and they'll do 95% conventional manufactured homes. Okay, yeah. Think about that. So those people that may not qualify.
Okay? So what are the driving forces behind that? Some folks say manufactured home is more affordable, and they also say the build quality has gone up quite a bit over the years. What else is feeding into that?
Well, the other benefit is your people that are living in a manufactured home now that want to sell it, getting buyers to qualify to buy a first-time seller's manufactured home has been difficult. The rates are higher, the thises are higher, the that are higher. So it's been put into a position that they're going, look, their point is, and I'm using my term, not theirs, we need to juice the wheels of a normal market. That's what they need to do. That's what their stated goal is. So in order to do that, we have to have a normal market. And that normal market is a first-time seller doesn't sit in the house forever. Okay. They will normally sell in that 5 to 7 years. Okay. Some people, a manufactured home purchase a lot of times is a end of home ownership. My wife sold a house to a couple, a manufactured home to a couple that, they were significantly retired, and it was a retirement home. And again, they want to make it easier for what does a retirement home mean? Well, the before retirement home usually is the 4 to 5 bedroom, 2-story house, dream house that they raise the kids or grandkids in that they now no longer need. It has a pool, it has a backyard, the basketball court, got all these rooms they don't need. They need a 2 or 3 bedroom house in a resort community. So they're trying to grease the end of the market and the beginning of the market to get people off the interest rates. That's their stated goal.